What's up, everyone? I'm TK Paps, and I am back with episode 3 for once again to go through a portfolio update, and then I want to talk about the system I use for ensuring I'm always creating wealth for myself. So to get right in, the portfolio is currently slightly at a loss, which is down from the previous video. Right now it is valued at $2,178.22, and with a unrealized loss of negative 0.19%, which is $4.20. We could see that as we keep scrolling on our web application, which you could see in real time, publicly available at tkpaps.app, our chart is obviously going up, but that's mainly due to the contributions we're making. And on that point, yesterday purchased another purchase of Bitcoin of $250. So we could see that there. And then we can then see where the allocation is at. Currently, 67.6% of the allocation is towards Bitcoin. And this is very lopsided right now just because, as I stated in a prior video, the main goal right now is to just buy Bitcoin and get Bitcoin to about $2,500 where we want the allocation to be. For whatever reason, not necessarily random, but I fully believe Bitcoin is going to continue to run, and I just want to get it in as quickly as possible. I think even after I get the $2,500 in, I'm going to continue to purchase Bitcoin weekly, regardless of where the price moves. As I've said before, it's just a strong conviction I have. But as we keep going, we have 17.7% big tech, 11.6% dividend producing assets, and then 3.1% of international equities. Nothing else has really changed since the last update other than the additional purchase of Bitcoin. And then we could see the ideal, which I'm obviously still far away because I need to get the initial capital into the fund first. And as I said, Bitcoin is going in first, and then I'm going to purchase the other allocation assets, etc. But then we could see the breakdown. Right now, the Bitcoin holdings are down 1.89% on average, which is really what's driving the portfolio down. Google is still performing really well. I think it was at a 12.93% last time, so down a little bit, but still a 12% gain. And I think around a month is great. Then we have BKAG, which is a bond ETF. It's basically flat, down 0.01%. A share of NVIDIA, which is down 0.45%. And then an international ETF, which isn't much. I think it's like 3 shares, but that's actually up 3.33%. And then we could see that there's a little bit of cash, which I'm definitely still looking to accumulate. I want that at $1,000, but again, baby steps. We're slowly putting money into the fund, and we'll get there soon. But $68.51 of cash. And then this is my investment thesis, which I've gone over, I think, at least once, but numerous times. And, it's right there if you want to check it out. But again, just head to tkpaps.app, and this is all live and public, and you can see everything I'm doing. Now, I have a trading tab as well on here. This right now is just reflecting one liquidity pool position that I'm in, and it's performing very well, but definitely in the very near future, I want to make an update to this UI and give a little more details, and then also put in more things that I may, invest in. But that's it right now for the portfolio update. So without further ado, I'm going to get right into talking about the system that I use to make sure that I'm always generating wealth. I'm going to get into the system that ensures that I'm always generating wealth and managing my money in a sound, responsible way. So this is probably going to pertain mostly to people with 9-to-5 jobs, which I would imagine is most of you, or really just any sort of income. But the first thing, I think the golden rule is being aware of your tax advantage accounts. And first and foremost, that would be your employer-sponsored tax advantage account, which is typically a 401k for profit companies. And, there's a 403b, which mainly pertains to like teachers and nurses who work for like nonprofits or governments. And I think there's a thrift savings plan, which is specific for government entities. So with that, the first thing you want to be aware of is whether your company or employer matches your contribution amount per paycheck. And if they do, that's great. Like, that's basically free money as long as you're vested. And, sometimes there's a vesting period, which you should look into. But first and foremost, you're going to want to take advantage of that and ideally contribute as much as you possibly can. These tax advantage accounts, I could go into detail about the taxes and how that plays out in a different video. But you're going to save a ton of money on the gains and the appreciation of the assets that you purchase inside of these accounts. And the reason why I bring this up first is because it basically creates the system that you want to create for yourself. You're not creating the system manually. You are creating the system manually, but it does get automated. But you do have to go in and set these things up for yourself. The system with first approaching it to like a 401k is that money automatically gets taken out of your paycheck. So you're right out the gate, without even thinking of just clicking a few check boxes or buttons in your employee portal, you're automatically investing in a tax advantaged way. And that's right where you want to be at. So that's first and foremost. And what that is going to do from a visually perspective of what you're actually seeing is that's going to decrease the amount of money that you see hitting your bank account. And that, may hurt emotionally or psychologically a little bit. But it's all good. You're investing that money and you're putting it towards your future, your retirement, in a tax advantage way, which is going to be the best way you could invest money. So employer sponsored tax advantage retirement accounts, we got that out of the way. That's what you want to focus on first. Ideally, if you can maximize the contribution, which I believe is $23,500 for the current tax, that's where you want to be at. If you can't do that, still do as much as you possibly can, and that's a great place to start. The next thing you want to do, though, is once you get paid, you're going to get some amount of money deposited into your account. And what I do is I set up automatic transfers to hit the day I get paid. And this basically disperses money out to various accounts that are in line with my financial goals. So the first thing it does is send an amount to my Roth IRA account, which is about a $7,000 limitation per year. So if you do 26 paychecks or $7,000 divided by 26 paychecks, that comes to $290, I believe. So $290 straight into the Roth IRA, which will maximize that for the year. And that's another tax advantage account where you have basically freedom to invest in whatever you want. Personally, this is my favorite account because you can buy individual stocks. Maybe you find there's a big dip on Tesla or something like that. You can invest directly into these individual stocks. It's not really restrictive in any sort of way, where if you have experience with an employer-sponsored account, you're normally restricted to certain funds or certain assets that you can buy into. Now, I'm not saying that these are bad. It's just that you have a little more restriction. With a Roth IRA, you basically have total freedom. It almost acts as like an individual brokerage account where you can make any decision you want, but you then do get the tax advantage. But then you do get the tax advantage to the Roth IRA account that you wouldn't get in an individual brokerage. The next thing that my system does is it sends money into a savings account. And again, you should have an idea of what your financial goals are. So if you think that you're going to have somewhat of a significant short-term purchase, you're going to want to have cash. I think it's always just good to have cash anyway, save up for an emergency fund, things like that. But the next thing I have an automatic transfer for is going straight into a savings account that is ideally as high yield as you can find on the market. I think there's like better options out there, although I use Ally, which I think is a really good option. Although I think Vanguard, just having it in like the money market fund, and SoFi deliver better yields. But I like Ally a lot. The UI is great. You could like position your cash into different buckets, which doesn't necessarily mean anything, but it's nice to see like I'm allocating cash towards the emergency fund. I'm allocating cash towards tax payments, whatever it may be. Any of those expenses that you think are short-term, coming within the next 5 years or so, you would want to devote some cash to, and it breaks it out really nicely in their UI. So I'm a big fan of Ally, but that's the second thing that my system does, is it automatically transfers cash out of the checking account that gets deposited into my savings account. So it's just left aside. And then the last thing it does is transfer money to my individual brokerage account, which is just an account where I kind of experiment. I've been using some of that money to fund this experiment portfolio, the tkpaps.app that you'd see. And just, if I see something that I think is undervalued or I want to invest in, I just kind of use that money to play around with a little bit. It's not the most tried and true investing tactic per se, but I'm making videos about finance, personal finance, investing. I enjoy it, so it's kind of a way that I have some fun with it, a little bit of money to just play around with. So that is mainly the system in its entirety. And what it does, I think, like behind the scenes, is it helps you make unemotional, like psychologically sound decisions. And it's almost like a philosophy. So I've been doing this for years now, and I basically like live off of the money after all of those transfers have been made, and obviously the contribution to my 401k and everything else has been made. But like, that's obviously, I don't have any control over that. And this is great because like I feel poorer. I feel like I don't have that much money. Like I get paid and immediately money goes everywhere else, a decent amount of it. And I'm left with whatever's left over. And it's obviously nowhere close to like my gross compensation after taxes or anything like that. But it forces me to live below my means. It forces me to save and invest in my future. So this is why I think it's like the best system ever. It's super easy, very easy to set up. You don't think about it, and then it literally just starts creating wealth for you. You invest in these accounts, you save cash in a high yield savings account that earns interest, and it's just a system that works for you, and you don't even have to think about it. I'm definitely someone that wants to get a little more into like fine-tuning a budget and things like that. But for the past 5 years, I've grown my wealth fairly well. I've had I would say an above average amount of expenses that I've had to pay for, student loans. I just got married. There was a large wedding expense, a lot of other things. And I did use this system to help save for those things. But all in all, it works really well and will help you achieve your goals. Part of my point being, though, that even with all of those expenses, I was still able to grow my wealth because I stuck to this system. And stuck is probably not even really a great word, because I didn't have to use any sort of discipline. I set it up, everything worked for me, and I was still able to grow my wealth over the course of however many years it's been now, even with very large expenses. I also think a point that I was bringing up is, I want to get more fine-tuned with budgeting and everything, but even across those high expenses that I had the past few years and sticking to the system, I didn't really pay attention to my credit card bill very much. I paid it in full every month, obviously. If you're not, you definitely should. The interest rates are crazy on almost every single credit card. But I just wasn't crazy about it. I'm not a big spender. I definitely, obviously value investing. saving money, but I'm not a big spender. Like I like going out to eat. I'd have some nice dinners here and there, go out with friends, but I would spend, but I really wouldn't like look at the credit card bill very much, because like the system works. I know like how much money I have to work with. I know I shouldn't be spending so much money, but at the end of the day, I had to just stick to the money that was left in my bank account, and everything falls into place and works really well. So that's the system I use. I think it can work really well once you define your goals. Determine how much you have after you make contributions to your 401k. See how much is left over. See if you need like short-term cash for any purchase that you may need. Know your risk, know who you are. Some people are more risk seeking. Some people are more risk averse. Maybe you don't want to buy individual stocks at all. It's all up to you. But I think if you can define your goals really well and then implement this system that's in line with the goals, you could basically turn off your brain. The system, the money will work for you. You can just kind of be at peace. It's really great. I will say though, with one caveat, with some of these accounts, like even though the money is getting automatically transferred out, you do still need to go in and buy assets. So like, let's use the Roth IRA as an example. I have $290 come out automatically on whenever day my paycheck hits. You have to then like take that $290 and go into the account and buy an asset. So the money's there. Like it seems like in my checking account, I don't have it anymore. It's somewhere else. But if you actually want to like grow your money, appreciate in value, you need to purchase an asset. I don't know. I would hope most people watching or listening know that you have to do that, but that is something you do have to do. Like you can't just like invest. You can't just transfer $7,000 a year into your Roth account and then expect it to grow. You do need to go one step further, go into the account and purchase assets with it, which is just like a note to like have about the system. Is it works very well, but you do need to go into it here and there and like make purchases. You could do it quarterly, you could do it monthly. I probably wouldn't recommend yearly just because that's a pretty big time horizon. But I probably do it once every 2 months maybe into my Roth. The more actively managed stuff I do way more often. And I did talk a lot in my first video about asset allocation, specifically how that pertained to the portfolio, which you kind of just saw like me going through, the percentage breakdown of everything and what the ideal is of where I want to get to. And I broke that down heavily in the first video. But it's also good to have an asset allocation model that's maybe not as risk facing as something like I'm developing here, where you do like reallocate on maybe a yearly basis. So just as a super like easy example, and I think I already used this example, but just to reiterate, if you determine your asset allocation model should be like 50% bonds and 50% stocks, which is a fine allocation model. A lot of it is in line with, again, your goals, partially maybe your age, your risk tolerance, and just who you are. But let's say it's 50-50 and, the stock market pops off. And now like you're sitting at 60% of your portfolio is stocks and 40% of your portfolio is bonds, just because the stocks appreciated so much in that year. You should probably sell off some of the stock and reallocate to that 50-50 like baseline allocation model that you determined. And just knowing that, because you set that to start, those were in line with your goals, and that 50-50 allocation like percentage, that model will help you achieve your goals. Like that's why you set it in the first place. So reallocating on probably a yearly basis is recommended a bunch by people, and it's something I do as well. And the really cool thing about that system in itself is, one, you have to do it once a year. I mean, we're talking like 6 hours of hands-on time of your finances a year, and you could basically like get to financial freedom if you do everything right. But like the 6 hours, you go in once a year, and what that does is, like, let's say the stocks are up and you reallocate to your bonds. Now you could per se, like if you have cash or whatever on hand, you could then buy like however much percentage of bonds you need to make it go back to 50-50. That's not a bad approach. But I think most people wouldn't have like just that much cash sitting around that they're like, oh yeah, this is cash to reallocate my model, especially if like the account is large and like you might not have $100,000 sitting around to reallocate. But what people would do then, or what you probably should do, is sell the asset that appreciated. So in this example, stocks, sell it, and then with the proceeds you buy back into bonds, and then you get back to the 50-50. And the reason why this system is so great is because it basically forces you to sell when you're at a gain. Like the biggest thing that investors fall into is buying high and selling low. Like this basically kind of forces you, you're not going to get the peak per se, but it forces you to sell high or higher than you had it because you're sitting on that gain. And then if the bonds didn't go up, you're probably in a certain position where you're buying low. So it does work very well. Like aside from, the allocation model, getting it back to where it should be, reducing risk per se and things like that. I think it helps just principally, like make better decisions in terms of purchasing and selling your assets. So I think that's everything I have for today. Again, I always greatly appreciate the viewership, the listening. It's so early right now, it goes a long way, and any comments, likes, subscriptions is so greatly appreciated. If there's anything, you want to see in the future, if there's anything you want me to talk about, maybe I have some insight on, please let me know in the comments. Again, if you want to keep up with everything I'm doing, you don't even have to watch my videos. Just go straight to tkpaps.app. You could see the live public performance of what the portfolio is doing. And if you want to see, maybe not focus as much on long form, as this is like a 20-minute video, I make short form content on updates of the portfolios, where you could follow me on Instagram or TikTok, or even just go on YouTube Shorts or something like that. And you can get updates there as well. And I'll also be giving financial education tips here and there, and just talking about, kind of just condensed, way shorter. You're not going to get as much value, but it'll still be good content, and in the whole realm of investing, crypto, wealth management, everything like that. So again, thank you so much, and stay tuned for the next episode, where again, there'll be a portfolio update, and we'll see what I'll talk about next. Peace.